Hey, have you guys ever wondered what is the difference on what you owe on your credit card debt versus how much you're paying every month? Today, we're talking with Rhonda Johnson, Cornerstone Home Lending, one of my favorite Alaska home loan professionals, about part two of our credit scoring series. And we're going to dive in deep today about what is this thing about amounts owed, how much you're paying, why does the amounts owed affect my credit score? And so we're going to dive deep into that with Rhonda today. So, hey, Rhonda, how are you doing?
Hey, Melissa, doing great.
So, Rhonda, can you tell our viewers how long you've actually been in this crazy business called the mortgage industry?
Oh my gosh. So, you know what? This is May. So, next month is going to be 39 years I've been doing this. I cannot believe I'm even that old, let alone been doing this job for that long.
Oh my
Um,
gosh,
yeah,
39 years.
yeah, next month, June 7th, will be my 39th year anniversary. So, and I know you've been doing this a long time too.
Okay, not 39 years. So I started in 1998. So definitely not 39 years. However, you and I have been doing this together for about 16 years, where you and I have been growing and learning and teaching each other. And I have learned so much from you. So I know when I'm working with buyers, and right now we seem to be getting a lot of inquiries from people who are like, oh my gosh, did I miss the boat? I've been renting, my lease is coming up like August, September, I might want to move. And so we're really helping them by doing shows like this on how to improve your credit score so you could take advantage of better interest rates as well as fees. So credit, what does it matter how much I owe on my credit card? Like, who cares?
Right. So remember last session we talked about the five factors that affect your credit score. So the payment history, of course, which is the biggest factor at 35%. How well do you pay your bills? And then this next one, which is the amounts owed on the credit that you've been given. So what the ultimate outlook is, are you using the credit as a convenience or are you having to use it as a way of life? Do you need to use that credit? And if so, maybe we need to do a little budget talking. Or are you just using it for convenience because everything takes a piece of plastic now, right? And so the amount that you owe on your credit cards compared to your limits is super important. And like you said, that's the thing we're talking about is what do you owe on your revolving credit card limits compared to the balance, compared to what your actual limit is. So, like if you take out a car loan, it's designed to start off very high, and then you pay, and it's paid off. With the credit cards, it goes up and down. So, this is the second most impactful piece of credit on your in your credit score. And while it's not the biggest, which is your payment history is 35%, but this piece is 30% of your score. And so it's almost as important as how well do you pay your bills.
So if MasterCard sends me a credit card and the credit limit is 3,500, what you're saying to me is even though I pay it on time, that helps me in my 35%. But if I bring it all the way to 3,500 and just make the minimum payments, it's helping with my payment history, but it's hurting me with the amount owed.
Correct. Correct.
Wow.
So let's dive into that just a little bit deeper, okay?
Okay.
So this is talking about the balance to your limit ratios, the amount you owe compared to your limit, like we talked about. Now, there's a couple of things we're talking about credit cards, but there's a couple other loans that could be affected by this. One of them is if you happen to own your own home and you decide to take out a home equity line of credit or a HELOC. If that HELOC is less than $40,000, then it looks like a credit card to the credit scoring software versus a mortgage loan if it's over $40,000. So if you're looking at taking equity out of your home because a lot of home values have increased, right?
Mm-hmm.
You want to try to make it for $40,000 or more to not be affected by this factor.
And I know that a lot of our current clients have done this, especially over COVID, because they decided to stay in their house. They went to their local credit union, took out a HELOC, and it did improvements. Wow. I bet most people don't know that they need to go over 40,000 so it doesn't look like a credit card. Huh,
Right,
that's interesting.
right, right. And so that's a mistake I see pretty often. The next one is those furniture stores, four-wheelers, snow machines, motorcycles, things that you can go to the store and buy. And they say you have no payments for X amount of months and zero interest. And then in a bajillion months, you start paying us back. And those also look like a credit card on the credit scoring software. So if you go into the furniture store and you buy $2,000 worth of furniture, a new living room set, and they give you a limit of $2,000 and the whole furniture set is $2,000, it now looks like you have a maxed out credit card on your credit report.
Wow. And you're not making payments for 2 years.
Right, right. And so people don't understand this effect that taking those offers can have on your credit score. And I have seen this personally affect people's scores by almost 100 points. And when we get into our next sessions, you're going to see how impactful that can be.
Well, and that makes sense because I always wondered about that. Like Sadler's here in Anchorage is notorious for it.
Right.
Come and get furniture and you don't have to pay for 24 months. They always do those July 4th specials or Labor Day specials or Memorial Day specials. I think they have a special almost every weekend. So really it's not a special. Okay, well, that's interesting because I don't think most people think of that way.
Exactly. And one of our local ATV kind of stores had a special. It was $99 down and $99 a month for 12 months, and then you made real payments on it, and you could buy, I think it was like four-wheelers and stuff. So I had several clients in a row that were aching to get onto that deal, which was a good deal for them. But then when I pulled their credit, because now they need a garage right to park their new four-wheeler in, and their credit scores had dropped significantly because, again, it looked like a maxed out $8,000 or $9,000 or $10,000 credit card.
Wow.
So that's another factor to keep in mind. If you have credit and you choose not to use it for 90 days, then it's like you never had it at all. And so this affects not only the available credit to borrow, but it also affects the length of time that you've had your credit. So if you have credit cards and you don't use them, I would encourage you to at least once every 90 days, go fill up your gas tank and then pay it off, just to keep those cards active to show those nice low balances to limits.
Okay, that's a great idea.
And if you don't have a credit card at all, you can lose up to 255 points off your credit score. That's how important this factor is. So there's a lot of people that say, I just use my debit card. Debit card does not help you. It keeps you out of debt because you're paying cash, but it does not help your credit score. And so I have been able to help people improve their scores by many points, just simply by going and getting a very small credit card.
Right. And I know credit unions do that. They do, secured credit cards. You put $500 in an account and then they give you a secured credit card and the balance is zero because you put the collateral up of $500. And I mean, 255 points is huge.
Exactly. And I have seen this within 30 to 60 days, fix people's scores by over 100 points. And so doing this pre-planning is incredibly important so we can help give these tools as guidance.
So we have the revolving credit in the installments, right?
Right. And so installments, this does not apply to.
So installments is like my car.
Correct. Student loans, your car loan, anything
mortgage
that's
loan,
fixed
I guess, would
mortgage
be,
loans.
because a mortgage loan starts kind of high today.
Yeah, a little bit.
Price values, yes.
Yeah.
Okay.
So what's this magic ratio that we're talking about? So where does this make a difference, right? How much do you owe? What is that magic? So here's how the magic works with this. If you owe between 10 and 30% of your limit, so I have a $1,000 limit and I owe $100 to $300, you are going to see your score go way up. If you owe between 30 and 50% of your limit, you'll see your score go up, but not near as much. And then once you hit that 50 to 75% of your limit, you're going to start seeing your score go down. And if you do 75 to 100% of your limit, you see your score go way, way down. So again, when we're looking at credit reports, this is one of my first go-to factors to help people improve their credit score. And if you go $1 over your limit, it is like credit score death. I have seen that tank somebody's score by over 200 points because they went $1 over their limit.
Oh my gosh.
So it's incredibly
Well,
important.
and the irresponsibility of the credit companies allowing us to do that. Again, you have to keep an eye on it. And yeah.
Well, and sometimes, you've made a payment but it hasn't quite posted yet, and then you go make a charge, and then you forgot that there was going to be interest on what you owed, and it kind of kicked you over your limit. So, it happens, but it's super critical that if you keep your balance to your limit in this 10 to 30% range, then you're never going to have to worry about that.
Well, and if you're struggling with the 10 to 30, the minimum then is 50% under the limit. Don't max out. Just don't spend more than 50%. And pay it on time, because then I'll have okay points, because that's 30%, and I pay on time, then that's another okay.
35%.
Great. If I kept it 10 to 30, I'd be great. And of course, paying them on time would be great.
Perfect. Yep, exactly.
Wow.
Now, there's another secret that a lot of people don't know, and it's when you pay your credit card bill. So I have had clients come in many, many, many times saying, oh, I pay them off every month. But what I see on the credit report does not tell me that. And so we go through this secret on when to pay the credit cards. My husband is a perfect example. He's self-employed. He owns a mechanic shop, and he'll put $20,000 on his credit card with parts and engines and tools and things, tires and things. And then he gets his invoice and he checks it off with all of his expenses, and he writes a check and pays it off and uses it again the next month for his business, right? And when we went and pulled his credit report, I saw his score pretty low. And it's because that credit card looked like it was near its limit. So when you pay the credit card is critical. And here's the secret. When you get your credit card statement in the mail, then it's going to tell you, here's your statement closing date, right? And then it's going to say you have a minimum payment due by this due date, which is almost 30 days later. So this comes to you in the mail, you take a look at it, you make sure all the charges are right, and you write a check and pay it off, or send in your minimum payment or some amount of a payment by that due date. But whatever you owe on this statement closing date is what's going to get reported to the credit bureau. Now, sometimes when you make your payment, it takes them 2 or 3 days to actually credit that payment to your account. So if you're somebody that pays it off every month, and you're in the process of buying a home and you want to make your credit score look as good as you can, the secret is to make your payment 3 or 4 days before this statement closing date, not that due date that's out there like 20 days later. So make your payment 3 or 4 days before the statement closing date. Your payment will post, and now your lower or your reduced or your zero balance will post versus a maxed out compared to your limit balance.
And so it'll look like you're in that 10 to 30% all the time then.
Right.
You can maintain that 10 to 30%.
Exactly.
Okay.
Exactly. So we went through this with my husband, and we did this and just tested it for a month. And it was like 112 points that his score went up by paying that credit card 4 days prior to the statement closing date, instead of after he got the statement and paying it 3 or 4 days after he got the statement. It was like 112 points on his credit score.
Wow.
So this was a really good secret secret that I was able to use to help clients improve their credit to prepare them for a mortgage loan. And this was just kind of a really little known secret that I could
Mhm.
share and help them out. And that was all really fine and dandy and everything. But now there's something new happening out
You?
there that we need to pay attention to. And this is called trended credit. And here's what trended credit does. Now, today, our mortgage credit reports don't always show this. It will be happening in the future, though. So I like to talk about it a little bit right now because this is what they're going to be looking for. So let's use that as an example that I pay it off every single month. Now, where it will help us as lenders understand, yes, I do pay it off every month, is that this will tell us, the trended credit will tell us what the scheduled payment was and what was actually paid. So if you can see the scheduled payment was $15, but you paid $20,000 and paid it off, then we're going to believe you. Won't help your score, but it will help the lender know that, yes, I do pay it off every month. Where it will backfire on us is I pay $15, $15, and then boom, I pay $310 to pay it off so that my credit score will go up. Then the lenders will know that's not your actual habit. And so they'll know that you just did this to kind of
Increase your
adjust your
score.
credit score. So we have to be a little bit careful there. We used to get away with that trick a lot. This is in our future. And so we really want to practice the owing 10 to 30% for several months prior
Mhm.
to applying for a mortgage loan so that we can see that that's what the reality typically is for you.
Perfect. So six to, again, like we're working with these buyers that are reaching out to us right now that are not wanting to rent anymore. They don't really understand credit, how to use it, how not to use it. So I think this is a really great tip for them. Also, too, I do have to say that some of my higher end clients have definitely benefited from your tips and tricks. Because again, if we can get them over that 800 credit score, the
Mhm.
fees and everything else they pay are just so much less than what you
Right.
pay if you're in the 640 credit score. So I
Ex-
know that I talk to my clients about that all the time. Call Rhonda and ask her about her tips and tricks
mhm.
if you're using her as your mortgage loan officer, because if you increase that credit score, it just gets you a better interest rate. And then this world of rising interest rates, getting a lower interest rate today is a benefit to you in the long run as a consumer.
Absolutely, absolutely. And I'm going to show you, not our next session, but the next one, what kind of an effect the different scores have on your interest rate
Okay.
and your closing fees. So we'll go into that in pretty deep detail so that it helps really bring home the reason why we're even talking about this, because this is a huge amount. You're borrowing a lot of money on a home, and what you're going to be paying back for that money can have tremendous effect in the long run. So it's super important that we help you get those best rates.
So if you've enjoyed watching these shows that Rhonda and I are doing, remember this is part 2 of our credit scoring and how to improve your credit, what to look for, what to know that I really think very few people know about. And share this video with anyone you know, your kids, your parents, your nieces, your nephews, coworkers, everything, because everybody could benefit from these tricks. And then this new little tip she threw out today about the trended one. So if you have comments or questions, please put them in the comments below in the YouTube channel. If you're watching this anywhere else, make sure that you click that button of subscribe in our YouTube channel. And we will be doing these shows weekly. Follow me on Instagram, Facebook at Melissa Realtor or Melissa Realtor, no.com on Facebook and Instagram. And then we will see you next week for our part 3 in our credit scoring. So see you next week, Rhonda.
All right. Have a great week.
Okay, bye.